Good morning, everybody. We're just going to give it another 30 seconds for the rest of the participants to get let into the webinar, and then we'll kick it off. Let's do it. Let's do it. Good morning. I am Justin Ferraccio, I'm a partner here at SevenBridge, and this is Chuck Eberly.
Hey, good morning, everybody.
I think most people on the call know us, but good to say hi, and thank you for taking time to spend with us this morning or this afternoon, depending where you are. Just a quick kind of refresher of the structure and purpose of this meeting. This is to provide kind of a monthly update on what we see happening in the economy, what we see happening in the stock market, you know, tax advice. It could be a lot of different things. We'll bring guest speakers on from time to time, but it's meant to be a value add for our clients and friends of the firm. It's not meant to be a replacement for your meetings with us when you have important things pop up or review meetings. So, at the end of this call or during this call, feel free to ask questions. Those questions come directly to me. Everybody else in the webinar won't see them, so you remain anonymous, except for Chuck and I will know who's asking the questions. We'll get to as many as we can. If you have a question that pertains really to kind of your personal accounts, or something in your personal situation, feel free to ask the question or feel free to call us after and we'll get to the bottom of it. But I will share my screen. We'll kick off and we'll get moving. All right. So today's agenda, we're going to talk about, why economic growth and economic earnings matter. And then the two unsung parallels keeping the market resilient, because that's kind of the number one question we're getting right now. We'll do an economic breaker panel review, look at 10 different economic indicators and talk about where they are. Are they good? Are they bad? Are they okay? And which way are they trending and what do they mean? We'll look at Q1's earnings scorecard. We have about 10 to 12% of S&P companies have reported Q1 earnings so far. So we'll kind of go through those, look at the trend lines, which sectors are leading, what are lagging, and how do they look. And then we're going to talk about concentration risk, really about the Mag 7. How is Mag 7, distorting the picture? And then we'll dive a little bit more specifically into NVIDIA directly. And then, bottom line, are the supports still solid? What are we watching for? Which we be paying attention to? And the first thing I'll kick off with is a slide we look at every time we talk. It's just where the markets are year to date. And so the Dow is now up about 2.5%. S&P 500 is up 4.7. NASDAQ, which is more tech, AI focused type companies, communication companies, up 6.5%. Russell 2000, that's more small and mid cap companies, up nearly 10% now. Equal weight S&P, which I'll just quickly explain. The S&P 500 index looks at companies by market cap. So the biggest companies get a bigger weighting in that 4.7% return. So companies like NVIDIA are 7 or 8% of the total weight of the S&P. The equal weight takes all 503 stocks and then weights them all exactly the same and looks at kind of what's really happening. What are all the companies looking like right now? And then the bond market is pretty flat year to date still. Most bond market is. All right. So the number one question we're getting right now is there's so much happening in the world, so much going on. Why has the market remained resilient? Why does it continue to go up with all the noise happening out there right now? So resilience to chaos, and the market's weathered COVID, it weathered aggressive rate hikes, it weathered the tariff storm, and has now weathered the US-Iran conflict. And the reason that's happening is consistent growth. And again, we'll dive into that a little bit deeper. Economic and earnings growth very rarely get credit for what's happening, but they're the foundation of every sustained bull market run. And that's not been different here. They've definitely been the foundation of this continued run up in the markets. And then what we're kind of paying attention to, vulnerabilities. If either of those pillars cracks, the market footing becomes unstable. So that's what we're going to dive into today. Do we see anything that could be a crack? What are we paying attention to? So we're going to go through 10 economic indicators, and I'll just kind of spoil it for you. 9 of the 10 are good, showing no signs of slowdown right now. So the tens and two yield spread right now that's positive. So really kind of long-term rates are higher than short-term rates. And that's what we want to see that, when we see that, that means investors are looking at long-term growth of the economy in a positive light. Real interest rates measures borrowing costs against inflation. When they're too high for too long, it slows down growth, it slows down spending. So they are still a little bit high, but they are declining to multi-year lows currently. So moving in the right direction. Light truck sales, feels like a random one, but almost every small business or many small businesses rely on light trucks for, servicing. When light truck sales are high, it means that small business owners are confident in their businesses, confident in the economy, confident in their ability to go out and scale their businesses. So we want to see those high. They're rebounding this year. 12-month vehicle miles, again, kind of another metric you may not think to look at, but the more people are driving, it indicates that they're out spending, they're in the economy, they're shopping, they're doing all the things that we want them to do for a good economy. And those numbers are positive year over year. Average work week, this measures how many hours a week most employees are working. That's remained steady. What we're watching for is if that number starts to go lower, if the average goes from 36 hours a week to 35 hours a week, companies typically start cutting hours before they start cutting workforce. So that's what we're paying attention to there. Jobless claims. This is one of the most timely labor market readings we have right now. A spike would be an early warning sign that the job market is cracking. We're nowhere near danger levels there. Building permits. This is the one of the 10 that is still kind of a red flag right now. The building permits are down year over year, which means that people aren't going out trying to build new structures, new developments. They're not asking for building permits, which is they're depressed versus previous years. They are getting better, but we want that to continue to move forward. Business spending remains robust, so that means companies are out spending money on their businesses for growth. So they're spending money on equipment, infrastructure, technology. We want to see that remain robust. That's a great thing. Dr. Copper, not to be confused with Dr. Pepper, is an economic term that economists use, right? Copper is in almost everything that we're building in the country. It's in buildings, it's in tech. Copper has historically been a great indicator of where the economy is headed, and copper is very strong right now. And then crude oil. Crude oil remains slightly elevated. I think what to pay attention to with crude is it elevated because of geopolitics, or is it elevated for other reasons? And in this situation, it's been elevated because of the conflict with Iran. So it's one that we're paying attention to. It's gotten much better recently, and we expect it to continue to kind of level out here.
I think one thing to think about as you look at these indicators, it's more not looking at one report, it's looking at trends. How is it trending? Like with building permits are trending better, even though they're not where we want them to be, the trend is positive. Same with real interest rates. So even the ones that are, jobless claims or, some of these other indicators, what we're watching for is something changing with the trend. And right now we don't see it, but it's all subject to change. But these are things that we look at and we point them out. So maybe it's something you want to look at in your spare time.
It's a lot of fun. But you may be watching the news and hear about light truck sales, and what does that mean? Now you know. So we'll continue to pay attention to these, monitor them, update them when it's appropriate. But right now, we're really pleased with what we're seeing. And I think, again, it's just a good reminder to look past some of the noise that's out there in the news cycle, because no one's talking about any of this stuff on CNN or Fox. These are good things happening in the economy. These are good indicators. It's easier to talk about things that aren't working as well, but I think it's important to stay in tune to this as well. Pass it to you.
Oh, good. So, kind of to summarize what Justin just went over, 9 of the 10 indicators are clear. So, what we're seeing here is, no sudden economic deterioration. You know, all the things that, we just went over, they're all subject to change, but I think the bottom line is, um, growth, which we're going to get into, growth of earnings is the foundation and is certainly a positive, and that's what we'll focus on now. So we're in earnings season. Right now, about 10-12% of companies have reported their earnings. 88% of them have done better than expected or beat their estimates. Um, most of the sectors, 8 of the 11 sectors are, reporting better than expected earnings. One thing to keep in mind, the blended growth rate, for so far has been about 10%. But as we'll see in the next slide, the earnings are getting stronger, revenues are getting stronger, margins. That's why this market's so resilient. So tomorrow is a big day. Google, Amazon, Meta are all reporting their earnings. So we see some, weakness in the markets today because of some things in the news. But tomorrow it's on a, the market will be focused on those earnings in a big way. And as earnings are reported, I think you're going to see that start to take over the underpinnings of the market more so than, maybe what's going on in Iran. It's going to be focused on earnings growth. So this chart is showing earnings per share. You go back to 2023, you can see there wasn't much earnings growth, coming off of 2022. But you can see this year the earnings estimates are up 19%. So those numbers are reflecting earnings increase, so profit increase. And the trend line, long-term trend line, 7 to 9%. Is the average growth rate. So we're way above trend line. Something to think about. You go back to 2023 till now, earnings have increased 50%. And you ask yourself, why is the market continuing to go up? It's because earnings have gone up 50%. So if you think about, a company that you would want to own, and those earnings have increased 50% in 3 years, that price of that stock's going to go up. And that's what's happening with the broader overall stock market and the economy. So one thing to point out is concentration of earnings. So, the Mag 7, those 7 companies, 40% of the earnings estimates in the S&P 500 are those 7 companies. So we have to consider that there's a lot of concentration. If you look at, minus the Magnificent Seven, earnings for those companies are expected to grow at almost 16% this year. So that's, a great number, a strong number. One thing, if you think about the earnings of the Mag 7, most of it is NVIDIA, the chip maker. So you pull that out, the earnings growth doesn't look so great on the Mag 7. It's primarily NVIDIA. And NVIDIA, had a kind of a slowdown in its increase in price, but that's starting to pick up. That is something we own in most cases across the board at the firm. So, something to watch closely is earnings. That's going to drive this market more than anything else. Okay, bottom line here. Economic growth is, there is solid, very solid. Earnings growth are very solid. The important thing to remember there is earnings can come from a lot of places. Companies can, cut costs, they can cut people. They can do things to, change earnings that are not necessarily healthy. But what we're seeing is revenue growth is growing, and margins are increasing. So it's a healthy earnings growth, is the bottom line. So we see that as very solid. Something to watch for is concentration risk. Um, that's something we look at in each of your accounts is concentration. Are we overexposed? Are we overexposed to the Magnificent Seven, or are you exposed? Um, but it's also watching the impact of the earnings of a few companies doesn't make the whole market strong. So we're looking at broad strength. The other problem would be, something that would change the macroeconomic picture. So, an example of that would be prolonged increase in oil prices and the impact it has on inflation, the impact that it could have on earnings. Right now, we're not seeing it. Um, Energy prices are definitely elevated. That we're probably going to start to see that follow through in the consumer price index, and some other indicators. But those are some things to watch, but we're really focusing on earnings at this point.
Yeah. Awesome. Well, if you have any questions, now would be a good time to pop into the chat. I think just a reminder about how the stock market works. People think that the stock market is a snapshot in time today or tomorrow. And really just remember that the stock market is a forward-looking economic indicator. It's kind of pricing companies where they think they're going to be 9 months, 12 months into the future. So as of right now, the markets have recovered extremely well this year, extremely well this month. The stock market's moved past the conflict with Iran largely. It's looked into the future and it thinks that we're going to be in a place where it's resolved in the next few months, 6 months, whatever it might be, completely resolved. So I think keep that in mind. When things do change, it's projected, it's looking forward. It's just kind of thinking about where things are going to wind up. So there's been a lot of volatility in the market this year. This year, I think we've seen more 2 and 3% decreases and increases than I've ever seen consistently over a 2 or 3 month window. It seems like every day the market's not moving 0.5% anymore. It's moving 2 or 3, positive or negative, sometimes more. But where this roller coaster ride this year has gotten us to a point where, we're up and we're up pretty strongly for, only being 3, 4 months into the year. So again, overarching theme is things are largely good economically. Company earnings are strong, and we're kind of pointed in the right direction. And it's our job to kind of continue to think about it and stay on top of it and do our best to predict the future.
I think one thing interesting, if you look at your accounts or you look at where performance is coming from, it's coming from places that they're not the Magnificent Seven. They're coming from Caterpillar. They're coming from different industrial type companies that in energy, things that really underperformed last year. Some of like Caterpillar has performed great last year, great this year. We were just at a conference talking about the spend on AI infrastructure, and the number is $4 trillion on building out the energy needs. Without that, AI doesn't happen.
And that's just the next 4 to 5 years.
Yeah. So it's almost, that's as big as a government stimulus package just on that part of the infrastructure. So, I think right now the news cycle is focused on the war, which is important, but it's really the other things that matter that the market's looking at. It seems to us like the markets are looking past the conflict in Iran, looking past that, and what is the underlying factors that are going to drive things the rest of the year. That's why we wanted today focus more on something other than the war. I think that's going to continue to create volatility day by day, but we got to look at the big picture.
Great. Good job. All right. Well, thank you all for taking 20 minutes with us. We appreciate it.
No questions.
No questions today. We did such a great job. Everyone's just digesting all the data.
Yep. But you
But
guys have questions, reach out.
send us an email, give us a call. We'll talk through them. But we appreciate your time and we'll look forward to doing it again next month.
See y'all soon.
See ya.
Bye.